EU lawmakers vote to impose €1,000 limit on unidentified crypto transactions. EU lawmakers have voted in favor of imposing a €1,000 limit on crypto transactions where the customer cannot be identified. Entities, such as banks, assets and crypto assets managers, real and virtual estate agents, and high-level professional football clubs, will be required to verify their customers' identity, what they own and who controls the company, the European Parliament emphasized. On Tuesday, members of the European Parliament, MEP, from the Economic and Monetary Affairs Committee, ECON, and the Civil Liberties, Justice,
seeking to hold crypto last week. This mimics rules set out by the Basel Committee on Banking Supervision, the international standard setter for the industry, which has proposed that holdings of unbacked crypto should be given the highest possible risk weighting. EU Parliament member Marcus Ferber saying in the meantime, quote, banks will be required to hold €1 of their own capital for every euro they hold in crypto. Joining us now to discuss is Lucius Meister. He's the chair of Switzerland's largest crypto broker, Bitcoin Suisse. Lucius, thank you so much for joining us. So is this the EU Parliament's reaction to the crypto market contagion we've been seeing over the past year or so? And what will be the ultimate impact on the crypto industry of these restrictive rules?
So it's not their own rules. So it's great to be back on the show. Thanks for having me. So it's not the European Union's own rules that they're implementing here. So this is they're basically implementing the rules given by the Basel Committee of the Bank of International Settlement. And they have, over the past 2 or 3 years, created some, what they call non-binding recommendations, but in practice, all the countries have to implement them one way or another. And so they are really the standard setter, and they created very politically move from regulating crypto to containing crypto. And we will see. So I've prepared some slides. Maybe we should have a look at the first one. What the different strategies are, what the regulator could take. So there's basically 4 approaches. So the first approach is to ban crypto. And I hear that there are some member states in the European Union that would love to do that. They don't like crypto. They would like to ban it. But it's not compatible with the liberal political order. So you cannot just ban a technology that is not accepted, fortunately. So the next option is containment. That's what they are now on track doing. This means basically building a firewall between the traditional financial system and the crypto economy. And this can be seen as a good or a bad thing. So their intention is, of course, to protect, to shield the traditional financial system from the toxicity of the crypto economy, of cryptocurrencies. But maybe it also helps protecting cryptocurrencies from the traditional financial systems with all its faults and mistakes. So an optimist and Bitcoin maximalist sees this firewall as a positive, but it's a very drastic measure, and it's a departure from the other approach, from the regulator approach, where principles like same risk, same rules apply. On the regulator approach, which is the official approach of the Swiss government, which I think is the right one. It's the one where the government tells you, as long as you control the risk, you are fine. It doesn't take a political opinion whether crypto is good or bad. It just says you have to control the risk, and then it's good. And then there's a fourth approach, which I call laissez-faire, but they did not even consider that. So the other 3 approaches, this picture I copied from academic paper from the Bank of International Settlement. They didn't even consider the 4th option because the regulator doesn't want to do laissez-faire because that makes them obsolete. So regulators will never propose a laissez-faire approach because that would defeat their own purpose.
They wouldn't want that. So the Basel Committee rules for banks, what are they now?
Yes, so what they propose, and this will come into effect 2025, is that, and so we've heard before this 1,250% rule, which is the highest possible risk weight. If you multiply that by the normal equity coverage rule of 8%, you get 100%. So it means for every Bitcoin you hold for a client, you need to have 1 Bitcoin on top of that in equity, which is already extreme. But it gets more extreme. They say a bank can hold at most 1% and exceptionally 2% of its tier 1 equity in crypto. So that's the total exposure. and it basically prohibits banking with Bitcoin. It means you cannot have crypto deposits like traditional bank accounts. You can still have some crypto storage, crypto custody off balance sheet. This is fine, fortunately. So this is the good news. They didn't touch that. But the bad news is you cannot have a traditional bank account where the client just has a claim in Bitcoin, for example, because as soon as that exceeds 1% of tier 1 capital, you're not good anymore. The third rule is that crypto is not recognized as a collateral. So this means that if you want to give a Lombard loan as a bank to a client, normally you can take some collateral, say there's some securities, whatever, a house in case of a mortgage, and the capital requirements were lower because of that, because you're allowed to recognize that there is collateral in case your client defaults, but you're not allowed to.
If we were to take a look at an example of how this would work in practice with the bank, how would that look like?
Yes. So let's have as an example the UBS balance sheet, which I put on our third slide. So you can see that UBS has a total balance sum of 1,100 billion, which is a lot. And it has about 60 billion in equity capital. Out of that, there's 45 billion in tier 1 capital. So there are some crazy rules. For example, a bank is not allowed to count their own self-used real estate as capital, which I think it is capital. Economically, it's worth something, but they are not allowed to use as a tier 1. That's why tier 1 is lower than actual equity. So there are 45 billion of tier 1 capital. And this rule would dictate that they would can have at most 2% of that, which is 900 million in crypto exposure limit. That means there will be never any bank accounts exceeding more than 900 million, which is it's less than 0.1% of the bank balance sheet. And so it's nothing. It's essentially building that firewall to separate the traditional financial system and the traditional cycles of money creation and everything, and the credit market from the crypto market. This is, of course, unfortunate for all the banks that have crypto plans, because it means they are limited to essentially store cryptocurrencies on behalf of their clients. They cannot do much else. They couldn't give mortgages in crypto. They couldn't issue crypto certificates and so on. But it is also an opportunity, because it means that the DeFi guys like us, we can build something without being influenced by the traditional. We can basically build something on the green fields, and we have no competition from the existing banks. This, for example, concerns DeFi borrowing and DeFi lending. So this is great news for protocols like Aave, because it means banks are not allowed to compete with them.
And you say that Bitcoin maxis would say that this would probably be a good thing because you should self-custody anyway, but you say that there will be consequences on this, and what would those be? So
one risk here is, so what we see at the moment is there's pressure from two sides. One side is, due to FTX and everything, crypto should be regulated, and every crypto asset service provider should be regulated. So one kind of regulation, or the highest standard of regulation, is, of course, the banking license. And from the other side, we have pressure saying, even if you're a bank, you're not allowed to touch it. So in an extreme case where regulators should say, non-banks are not allowed to touch crypto because they are not banks, but banks are not allowed to touch crypto because of the capital requirements, no one would be allowed to touch crypto anymore. And then only the individuals themselves. So it would be a world of crypto maxis where everyone holds their own keys. The problem I have with that is that realistically, most of the people, they want convenience. They don't care that much about controlling their wealth. They prefer having an intermediary handling their keys. And even then, the crypto provides some value, because it provides them the opportunity to get their crypto back if they have a trustworthy intermediary. But at least they could delegate it to someone. So this is
right.
It's difficult for crypto, I think, in the long run.
Exactly. It would make it prohibitive for crypto in the long run, as you say. Lucius, we've got to wrap it there, but thank you so much for joining us. That was Bitcoin Swiss Chair Lucius Meiser.
Please subscribe our channel and share Expo Bitcoin.